In times like this, it can feel like there's not a lot to control. And what I hear you saying is that's actually not true. There's a lot you can control. Over the last few days, heightened tensions in the Middle East, looming deadlines, and the ceasefire involving Iran have understandably raised questions for investors. When global events like these dominate the news cycle, it's natural to wonder, what does this mean for my money? What will be the market fallout? And should I be doing something different or should I keep it the same? Today won't be about predicting what will happen next, but rather diving into how markets historically respond to geopolitical turmoil and what investors should keep in mind. Specifically, what's in your control versus what's out of your control. Hello, and welcome to a special episode of Money on Your Mind from Edelman Financial Engines. I'm Michael Liersch, a behavioral scientist, financial planner, and your chief planning officer at EFE. Thanks for joining us for a conversation about how people are feeling about their money, what they're wrestling with, and how financial planning can help you straighten things out. For this episode, I'm joined by Neil Gilfedder, our chief investment officer, who joined us previously on the special edition recording of our podcast when we discussed the potential impact to the markets following the U.S.'s conflict with Iran in late February. Neil, thank you for joining me today to talk about the escalating conflict and what that has meant for the markets.
Pleasure to be here.
So Neil, why don't you remind listeners and viewers what your role is as our chief investment officer at Edelman Financial Engines?
Yeah. My main role as Chief Investment Officer is to make sure that clients' portfolios are set up to help them achieve their goals and are maintained as market events happen, so people can stay on track in achieving their goals. That's really the core responsibility of a Chief Investment Officer.
Thank you, Neil. We really appreciate all that you do in times of uncertainty like this. And just as a reminder for our audience, the reason why we wanted to pull together this special episode is that a ceasefire was recently called with the US, Iran, and a negotiation is impending around what the terms of that ceasefire is, opening the Strait of Hormuz and really letting, let's say, that oil flow through the strait so that it can be refined and used by constituents who purchase that energy. And so there's a lot of consternation around that negotiation, also the tentative nature of the ceasefire, and markets are working through that right now. So Neil, can you give us a perspective on your thoughts on what's happening in the markets based on the potential scenarios and how we think it might play out based on certain events that could or could not happen?
Yeah, the first thing is what has happened. What do we know? So yesterday, as you said, a ceasefire for 2 weeks was announced, and markets were very happy about that. So stocks went up, and the oil price went down, right? So the idea was, people are expecting a better situation. There's a ceasefire. Oil should start to flow more freely at some point. There was a point in there about the Strait of Hormuz being opened. So you had that effect. Now, today is a different story. We're seeing markets, less confident about this. There's been a couple of things, right? First thing is you've got sticking points about the durability of the ceasefire, right? So first thing is you have the Strait of Hormuz still not open. That's one thing. And another thing, you have whether Lebanon is included in the ceasefire or not. So these are two, I think, sticking points about the durability of the ceasefire. What you've got then is also a longer term question. So the negotiations start very soon, and those are meant to come up with a lasting and durable settlement to the situation. What are the chances of those talks succeeding? There are some big sticking points in those. And so markets are looking both immediate and through that. And beyond that, then you have what are the implications of anything, any settlement or any resumption of hostilities. So, you have had oil refining capabilities damaged during the war, so that will take time to work out. That's a longer term phenomenon. You've got what will the conditions of any future peace be like? So What the market is doing is ingesting a lot of information and trying to figure out, what does the future hold? What does it actually mean for assets in your portfolio?
So Neil, that's a really helpful breakdown of the situation. And when you're talking about yesterday and today, I just want our listeners to know that, and our viewers to know that we're recording on April 9th, about the middle of the day, Eastern time.
Yeah.
Why don't you describe to our listeners and viewers, how markets really work in this situation, and ultimately how they should think about that in terms of, this idea of staying in the market, so time in the markets versus market timing, right? Getting out, when things are let's say volatile, or they don't feel great, or getting back in when things become good again. Can you break that down for our
Certainly.
viewers and listeners?
Yeah, this conflict is, I would say, an extreme example of what markets do every day, even in calm times, right? So markets are forward-looking. This is a key point, right? So markets take all of history. That's all taken as given, right? Markets are looking forward to try and figure out what is going to happen, and the price in the market is actually the sort of the net effect of all people's different views in the market, and that sets the price, right? So every day, whether it's a quiet time or a time of crisis like we're in at the moment, markets are always processing information. And we see this regularly when an unemployment report comes out. Markets are looking, they have an expectation. If unemployment is higher or lower than expected, markets will react. When inflation numbers come out, the same thing happens. So markets are always looking for news to digest that gives them a signal about what the future holds. And so, a consequence of that is, when you're trying to guess, do I get in or out of the market? This looks like a scary situation. You're not, it's not you versus, an understanding of the world. It's about you versus second guessing everyone else in the market whose opinions are baked in. And frankly, it's very hard to do.
In the portfolios that you effectively monitor and run, Neil, you and your team, how do these types of market movements, the information that comes at you and then is ingested in markets, and there's either a reaction or not to that information, how do you, let's say, incorporate that into your portfolio management and your discipline along those lines?
Yeah, I think discipline is the key word, right? You want to be ready, to be prepared for a crisis. So history, there's been, events throughout history, right? There are always things that crop up. The key is to have a process and a philosophy that's set up in advance and maintained, so that when stuff gets, difficult in markets, you're ready. We are not making this up by the seat of our pants, right? We have a process, we have staff assigned to this. And what we do is to make sure going into it, people's portfolios are in the right spot. And during it, we make sure that we maintain them, meaning if stuff gets out of whack, we will true up the portfolios. We have processes set to do that. So really, this is where I think the discipline most shows its value, is that, we are ready for this. It's not comfortable for anyone, but we're ready. And that's can give people confidence that, with a portfolio like that, they're best set up to navigate these kinds of markets.
So when you say the words true up the portfolio, I can imagine our listeners sitting in wherever they are, on a train, in their home, on their run. What does true up mean in this sense?
And it links very much to the idea of a diversified portfolio. So a diversified portfolio is one not really that just has lots of stuff in it. It's a portfolio that has exposure to different sources of risk and return, right? So for example, you have exposure to large cap stocks, you have exposure to energy stocks, you have exposure to government bonds, you have exposure to foreign stocks. There's a whole array of these that we design portfolios to have exposures to. Now, what can happen when markets, are in a period of heightened tension is that portfolios can deviate from these. Certain things can run up or run down. What we do is to make sure those stay within bounds. And we have processes that will then check these on a regular basis and bring them back so that the portfolio isn't getting out of whack because of events happening in the markets. So it is something very specific, I mean, by true-up portfolios.
So then let's shift to this idea of, again, the listener, the viewer in their home, on that run, on that train, they have their mobile device or their computer with them. They look online, they look at their account, and any given day over the past month, they see the value of their portfolio, whether, Neil, it's managed by you and your team or by another professional, or they're doing it themselves.
Yeah.
They see that going up and down. And at times that can feel, even if you have this level of discipline via someone like you or another professional, or you have your own discipline or not, that can be, in a sense, it could feel a bit like an emotional whipsaw. Right? As it goes down, you feel despondent. As it goes up, you may feel more elated. How do you think then the person listening to this or viewing this should react in that context if they have the discipline that you're applying to a portfolio? What should they do here?
Well, I mean, the first thing is it's a completely natural reaction, right? I mean, there's your hard-earned savings you're seeing gyrate, right? And even the best diversified portfolio is going to see that, right? It doesn't get rid of that completely. I think the key thing to do is to take a long-term perspective, to zoom out, right? So, the S&P 500, the main U.S. equity index since the Great Depression, and what you'll see on that are crises crop up throughout. So, obviously there's the Second World War, there are, the 9/11 attacks, Vietnam War, Iraq War. There's a lot of these things that happen, and all of these are difficult and uncomfortable periods in general, but as an investor as well. But what you see is the market moves beyond. There is a period of volatility, and the market keeps growing over the long term. Why is that? It's because the driver of the market in the long term is the value you're holding in productive assets. It's uncomfortable in the short term, and every time does feel different, but there is a long-term pattern that the economies around the world, are full of like entrepreneurs and business people looking to grow their companies, regardless of the conditions. And over time, you own a slice of that, and that's what makes portfolios grow. Short-term events can knock that for a bit, but that long-term impetus is still there.
But what if, Neil, I'm going to challenge you on this, if I could just detect the time where the market's going to go down, and so right before that I exit, and then I could just detect when the market's going to go up. So maybe I could have predicted that the ceasefire was going to happen a couple hours before it was announced, and I just went back into the market. Tell us, is that possible? Can you do that reliably? And what if you get it wrong? I think is the key on that one. Can you describe a bit to us what that looks like?
Yeah, so key thing here is the markets collectively are looking to do exactly that, right? Everyone's trying to figure out signals. So you'll have to be sort of, better than all of the people who are professionals running short-term investment strategies to capitalize on this.
So computers, humans and computers, professional investment managers.
Exactly. And people with risk budgets to exploit short-term phenomena, they have an extremely hard time doing this. There's little evidence that people can do this consistently through time. A second point is you have to get it right twice, right? You have to figure out when to get out correctly, and then you have to figure out when to get back in correctly, right? Both of those are difficult. And even if you get the first one right, what people will sometimes do is stay out too long, right? They got out, they're like, phew, I'm out of this thing. And remember, markets are forward looking. Markets are looking beyond this already to try and figure out what's going on. And they pick the wrong time to get back in, right? Or they wait too long. And so the markets rally. And, we've looked at this, others have looked at this, and it's extremely hard to do this consistently.
And we saw this a lot. Speaking of charts, and I want our listeners, our viewers, to go to now like feelings and intuitions. And it was interesting, Neil, that you say that. I was on a train, and you and I called you on that train ride.
Yeah.
Right before the ceasefire was announced, and on the train, everyone was talking about what was going to happen next.
Yeah.
And no one knew. But your point is, on the whole, doing that, getting out, getting in, and doing that over and over and over again is a really tough challenge. And I do think it's really important to think about, times in the past where that temptation existed. And I'm thinking back to COVID, Neil, or the financial crisis. Those are, I think, very memorable times where, and I want our listeners and viewers to think about this. Did you or did someone move out of the markets, to your point, Neil, and then just not get back in at the right time? And they missed, Neil, a bit of that upswing and kind of got in there, at the tail end of it. And we know a lot of those stories, Neil. We've seen that in investor behavior. And I just want our listeners and our viewers to think about, did you do that? Do you know someone who did that? And what are the implications of missing that upside? That's effectively what you're talking about, Neil. Correct?
Yeah. And the thing about the upside is a lot of upside or returns are concentrated in the returns of only a few days a year, right? So most of the return you get is from a few days, and those few days are often in volatile periods. So if you sit this out, you are missing out on those. And what our work and the work of others has shown is that trying to do this just eats away at your portfolio's return. It just, crisis by crisis, if you do this, you're losing return. Just for the fact that we don't know what's going to happen. There's a ton of uncertainty in the world. It's better to, as you said earlier, stay in the market, time in the market, rather than to time the market.
Just to put a fine point on this, the behavioral science behind it, Neil, which a lot of our listeners and viewers don't know, but I know you and I are well studied on because we live this each and every day and we resist it ourselves.
Yeah.
Is this idea that when markets go up, that feels like the time to go in. And when markets go down, that feels like the time to come out of the market. So I hope you're hearing what Neil is saying, which is if you do that over and over again, effectively you've missed the upside. And then you keep locking in losses on the downside as they call it chasing returns, as you try to chase returns. And so that market timing is generally speaking unsuccessful. So that's why this investment discipline, staying invested, monitoring your exposure to risk is so critical in a time like this. So all of that said, Neil, as we close out this special episode, what do you think is one action, because we always like to highlight that on the podcast, one action everyone listening or watching should take right now?
I think the thing to do is to focus on what you can control, right? So, if you may have worked with someone to develop a plan, you may have a plan of your own. Make sure your portfolio is set up to meet that. I would advise people not to try to set up their portfolio sort of opportunistically to try and base it on what's going to happen in the short term. Make sure your risk tolerance is where you want it to be, where it should be to fulfill your plan and that you're comfortable with, and keep maintaining the portfolio. And that would be my advice. It's never a comfortable time when markets are like this, but being disciplined really is a recipe to increase your odds of success.
With that, I just wanted to thank you, Neil, for being the CIO of Edelman Financial Engines. Yep. Speaking of confidence and control, we're so happy that you're here and you're sharing your wisdom with both people who work with EFE and people who don't, so that they can understand how they may approach a situation like this. Any last words of wisdom for our listeners and viewers as we close out the episode?
Only to reiterate, just focus on what you can control. Your plan will serve you in the long term.
All right. So with those last words, we'll close out the episode. And I just want everyone to know that's everything we have for this episode of Money on Your Mind. A big thanks to our guest, Neil, for joining me. And we'll be back next Wednesday with a new episode. Please subscribe to the show on Spotify, Apple Podcasts, or YouTube so you don't miss it. I'm Michael Liersch from Edelman Financial Engines. Talk to you next time.